Welcome to Your Money, Your Call. It's bonds versus equities. I'm Todd from FIIG Securities. If you have any questions about the share or bond market, pick up the phone, call us on 1300 30 34 35 and the email yourmoney@skynews.com.au. Joining me on the panel tonight is Martin Wetton. He is an interest rate strategist at Nomura, and Craig Banning, who is a director from NAV Wealth. Gentlemen, welcome.
Thank you. Good.
An interest rate strategist.
Yes.
I love that. So do you want to tell the viewers what an interest rate strategist is and maybe sort of explain a little bit about Nomura as well?
Sure. Interest rate strategist is a role primarily within banks or investment banks where the person doing that role is tasked at looking at both the government and the interest rate swap curves, so the wholesale market, financial markets. You look at the shape and slope of the curve. You look at absolute yields. The curve being the interest rate curve of from cash rates at 0 day out to the maturity of the bond curve. That will encompass Australian government bonds or government bonds of the country you're looking at. And for me, obviously, Australian government bonds, the state government bonds of the various states in Australia, the interest swap curve, the curve where banks lend to other banks, the relationship between those, and other government markets around the world.
So you're a dollar block strategist.
Yes.
So that means US dollars,
Australian dollars, Canadian and New Zealand. They're generally grouped together because they're commodity currencies. They have high correlations to each other, and they tend to be markets where, as a global investor, say a fund manager or a central bank, you have the means within your portfolio to trade between those securities. You may favour one over the other.
Does anyone favour the Kiwis? Because I don't favour the Kiwis.
From time to time they do, yeah. It's a smaller market, so it's...
Since they smashed that South Africans, they probably would have been buying Kiwi.
Yeah, well, actually, the Kiwi's been a very popular market in the last couple of months because it looks like the interest rates from the central bank are going to go up there next year, and people have found it more attractive.
When they would lose the World Cup on regularity, the economy would die.
Tank, yeah.
You could sell Kiwi interest rates and you'd be sure to make money because they're all depressed and
absolutely
going under sheep.
Yeah.
Hello, mate. How are you?
Very good, Mark.
How's business been?
Yeah, very good.
You were saying before we came online it's been a little bit gangbuster. So what's happening? What's driving all that?
I think what's interesting is when people feel more confident in markets and in their business, they then think, let's go and get advice. So we've had this huge rush of people in the last probably 3 weeks coming to us and say, okay, Craig, we've got to start planning our future, let's go.
But why are they confident? You know, the US looks silly. Mr. Abbott's come into power. Is that what drives them into confidence?
Maybe some of them are
weddings to go to. They can claim.
I think some of them are looking at the last year's return, end of the financial year. So we've published all our returns on all our funds. So that they're looking at their returns. That's good. Yes. You know, the government change, I think, has created a bit of positive feel through the clients we deal with.
And it would do, because there's no opposition. It's not like, they haven't delete us. You've got this honeymoon period as well as this non-whinging period, which is quite good for everyone. I think they can turn the TV up now.
Yeah, which we just love. I mean, we love it when clients want to plan their future. You know, that's what we're all about.
So when it comes to that, and we've got an interest rate strategist from Nomura, clearly an expert in his field. That's a great thing to do. But how do you define and tap into those experts? If I show up to you and say, look, I want widgets. I want to trade widgets. How do you find an expert?
So the way we work at NAV Wealth is we have internal advisors, of course. We have financial planners, accountants, lending specialists, insurance specialists. But a lot of the time, we need to find specialists outside that. So we call them our advice partners. So when we look for advice partners, we look for specialists in particular fields. So and there's two parts to that. There's the advice providers. So do we need a specialist tax lawyer? Do we need a specialist estate planner, for example? Then on the other side, the investment side, Mark, where you're referring to, is we then need to find an expert on fixed interest, or we then need to find an expert on hybrids, or we then need to find various, or fund managers perhaps. So we're about going and finding all those specialist people and bringing them together.
And is that your value add, being able to identify who is the specialist and who's just a spoker?
Absolutely.
Yeah, right. Has the US, the behaviour at the moment of the US Congress and all the US, we talk about this a lot on the show because it's definitely the animal that sneezes, we get hurt. Are your clients talking about that, or are they just piling?
Not really. All they keep saying to us is, is my strategy right for what's going on in the world and the market today? And so we'll sit down with those individual mum and dad clients and say, well, okay, let's look at your asset allocation, let's look at your strategy, and let's look at the impact of what's going on, whatever it is at the time, on your strategy. So we don't get a lot of noise from the mum and dad clients, no.
But you would. So
certainly.
What's the noise like at the moment for you?
The noise has been noisy.
Yeah.
The issue in the US has bewildered policymakers, investors the world over, and most people will look at what's going on in the US and throw their hands in the air and just think it's just an incredibly irresponsible way to run policy. Both sides can take some blame for this, so I'm not going to point fingers. Clearly, the majority of people within polls that have been done by people like CNBC are saying it's Republicans' fault. But in terms of what it's doing to markets, it's killing equities in the last few days.
Yeah.
It's seen bond yields fall quite substantially. But then, in the very front end of the interest rate curve, maturities of less than a month or around a month's time, you've actually seen government securities in the US, their yields spike very, very sharply.
So for the viewers at home, what we're talking about here is the T-bills, the Treasury bills, and it's where the government funds itself for 1 week money, 2 week money, that sort of stuff. So what's happened is it's gone to, 5-year highs?
We've gone to 5-year highs. We went to around 51 basis points. Now, knowing that US cash rates are at 0, T-bills expiring in a month should be 0 to 1 basis point in terms of their yield. So they're 50 points higher than that.
And we're talking about a lot of the noise, and for the viewers at home who can hear the noise in the background, please feel free to email that one and say you can hear a lot of noise, because we need to try and get people to be listening to us. Half a basis point doesn't sound like a lot. What's the size of the T-bill market in the 1 week, 2 week, 3 week period?
Well, the maturity of the T-bill that's coming up on October the 30th is $30 billion, so it makes a substantial difference. Now, it's not so much about just that T-bill, but a lot of the mums and dads that you would deal with, their equivalent in the US would put money into what are called mutual funds. A lot of that money in the US, and this is not just from a retail side, but from an institutional side, they park money in the safe haven of what is T-bills. And when they're seeing the yields on these spike quite dramatically, with the potential for a complete capital loss if the US were to default, it's quite a substantial amount of money that is at risk.
I remember in the 2008 crisis, it was, break the buck. There was the idea that these funds, for the viewers at home, these massive mutual funds are very, very conservative. And they actually lend the money for the 1 week, 1 month, and they're just giving you cash plus. So to some extent it was, in those periods, 0, but people just wanted their money back.
It was the old adage of Mark Twain that I was more concerned about the return of my money than the return on my money.
Yeah. So that's a bit of a challenge for some of the viewers when they're putting their money to work and finding out they're losing money in a cash fund for something so short. We're seeing a change in the US now because we've got a new Fed chairman.
Yep.
What's your thoughts on the choice of Yellen?
The second choice of Yellen.
Yeah. We knew that your sentiment is that it was Summers. That was the choice that they wanted. So we can talk about the chaos of Summers in a minute. But what do you think of Yellen?
Well, we think she's an outstanding candidate, nonetheless. So it was her or Summers. Both are very, very good candidates. One, in Summers, was someone who had the ear of the president, very much so. Strong economic advisor, very strong on monetary policy, quite a political player, and well known for that, and very close to the administration. Yellen is more the quiet academic. She's been actually instrumental in developing things like the forward guidance policy in the US, but she's also been what's known as a dove, someone who's been prepared to keep rates low or cut rates artificially low. She's been an advocate for QE. And she, for investors, is the sort of person they actually want in that seat, because she's not going to start the tapering. She's friendly for financial markets. How does Yellen affect Craig? In the sense that you get a lower for longer policy for interest rates, i.e. the Fed doesn't put rates up for an extended period of time. It means that equity markets are going to stay buoyant. Fixed income markets are going to have low yields out to 2016, which is the forward guidance of where they say they're then going to put up rates should they hit their targets on unemployment and growth. Right. So it means that it's a positive for investment markets. That correlation of US equity prices will obviously mean a better return probably for Australian equity markets over a period of time, or global equity markets. Right. And it also means that those companies that are affected by interest rates, which are most of them, and therefore what the consumer does, they have their input costs in terms of their financing costs stay lower for a longer period of time.
We'll talk more about that in a second, because I'd like to hear what you think of the IMF. But we will leave it there for a very quick break. If you'd like to speak with any of our expert panel, please feel free to call us 1300 30 34 35. The email yourmoney@skynews.com.au.
Engineered to endure with a lifetime guarantee. Taubman's Endure.
Copy that.
From 24,990 drive away, the new 2014 ASX is the street smart SUV.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi!
Ben?
Yeah.
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
The inventors of Twix had a falling out, so their production of Twix was divided between two separate factories. Left Twix factory cascades caramel and chocolate onto cookie, while right Twix factory flows caramel and chocolate onto cookie. Today they share nothing but a wrapper and a driveway. Try both and pick a side.
Life is a journey in which we're all travelers, looking to make that great trip with someone. Journeys are made by the people you travel with.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and tonight I'm joined by Martin Wetton, who's an interest rate strategist at Nomura, and Craig Banning, who is a director at NAB Wealth. They're here to answer any of your questions. Pick up the phone, 1300 30 34 35, and the email yourmoney@skynews.com.au. They'll answer any questions unless they don't know the answer. So I have a question for you. Do we pile into equities?
So you know me, Mark, I like to look at the individual client scenario.
Right,
but
so the answer is yes.
I guess the way I would look at that is that what's interesting now in the self-managed super fund space, where we're very heavily involved in self-managed super funds, there's about double the cash now sitting in self-managed super funds to what they're prior to the GFC. So we're spending a lot of time looking at individual client portfolios and saying to them, gee, look at this, you're low on equities, your allocation to equities is low. So at the moment, we're now starting to move back into there. We were a year ago, but we're now reassessing and moving in again, dollar cost averaging in. So the answer to the question is, generally speaking, we are now dollar cost averaging into the market because of the yields, and we still feel the Australian share market is too bad.
And when you put them into those equities, what are you looking at? So I'm dollar cost averaging just across the curve. I'm just buying the whole index, or do I say, well, actually, I'm only going to buy the four majors in Telstra because that's, and West Farmers or whatever, you know?
It wouldn't be the whole index, because our philosophy at NAB Wealth is that clients have a core portfolio of 15 stocks, which will be their blue chip yield producing for our retiree type clients or pre-retirees, and then for the small cap, we go to manage funds for that. So, and let the fund managers do their job to select, good quality companies.
How many fund managers on the small caps do you like? And I don't want you to name any.
There's not
you
a
can
lot.
name them if you like.
There's not a lot, but there are a few that we use. They've had a bit of a tough time in the last year or two, as we know.
It's going to be hard to find a good one to do that at the moment, because it's been it's deadly.
Yeah, the last couple of years have been hard for small caps.
Yeah, I think it's also hard for fund managers in general. You're trying to find, this is the fee I want to charge, you know, this is the performance I've produced.
Yeah.
There's a distinct correlation to I paid you too much for such a bad return. There's a relationship around that, so it's a bit challenging, isn't it?
Yeah, I think that's why we balance it up between direct assets and managed funds. So direct shares will have managed funds, but when we choose managed funds, we tend in our practice not to choose blue chip managed funds.
Yeah, right. With the interest rates where they are, I mean, is that troubling the clients? By that I mean, if you're borrowing, it's great, but if you're trying to live off dividends, and traditionally you've been off term deposits, is that proving the bogeyman that I'm going from the safest asset that I can get, a term deposit, effectively, into, well, I'll buy the equity, and we would sit at FIIG and go, hello, that's a low stuff.
Yeah, and obviously we've got to include bonds in there for those clients that are living off income. But we've been so lucky in Australia, haven't we? I mean, with our banking stocks producing unbelievably
high dividends
and franking credits on top of that. We've been so spoiled. I'm sure you find that when you're travelling the world and you see what's going on in other countries. I think we've been very blessed here in Australia because of our high dividends and franking. So I think some clients do have a higher weighting to that asset class, and particularly banks, than probably what they should have long term.
Yeah. And the term deposits are proving a burden because the banks... we had Steve Lambert here from the NAB last week, and he said, look, the reality is you can't pay any more. You just cannot pay any higher for term deposits because people are generating mortgages at, you know, such low rates, whether it be 4.5, you know, 4.70. You know, that's... So what are you going to pay for a term deposit? There's not much margin in it.
No.
Forward guidance. You spoke about it a little bit earlier. Do you want to tell the viewers what that actually means?
Sure. Well, forward guidance is a policy that a number of central banks around the world have adopted in the last few years. The Bank of England, most recently with Mark Carney, who's their new governor. The Reserve Bank of New Zealand's been doing it for a number of years. Bank of Canada's kind of been doing it, but really probably the most important two are the ECB and the Fed. And in terms of where it's most important right now, it's with the Fed. And forward guidance effectively lets consumers and businesses and investors know where the Fed stands on their monetary policy and what they're going to do.
And by monetary policy,
interest rates, their cash rates. And so effectively what they're saying at the moment is they're not putting up rates until 2016, and they need to see unemployment falling below 6.5% as a threshold to do that. That's part of their mandate to unemployment. So the forward guidance also matters for the investor side, because what we saw in late May when Ben Bernanke first highlighted the fact that the Fed was going to start their tapering, or start to taper their QE program, i.e. buying less bonds on a monthly basis, we saw yields spike very sharply. They went up about 120 basis points in US rates.
It was going to be a disaster.
It was. Most importantly, the mortgage rate went higher. Now, the ironic thing about the US is that what got the US into its problems, mortgages and liar loans, etc., was the thing that was getting them out, the housing market turning back up and lifting wealth. And with the mortgage rate spiking so significantly, it made it quite unaffordable for people who were still at a very high unemployment rate, over 7%, to get loans again. So the Fed had probably erred in going a little bit early.
You've answered that Republican question. You should have just lied. You should have said, well, whatever, I'll think about it when I think about it.
Yeah. So mortgage rates went higher. The Fed is trying to guide those back down and Treasury rates down because they've got to finance themselves. If they get a loss of investor interest from both their domestic buyers plus international buyers who buy US Treasuries, and it's a $13.5 trillion market, the interest bill when you go up 100 basis points is quite significant.
For the viewers at home, the US 30 years was in the low 3% for the mortgages. And the US mortgage market is interesting. You can refinance all the time. You pay them $1,000 and refinance. It's just an anomaly. It doesn't seem to make any sense. I'm Wells Fargo and I'll lend you $100,000 for 30 years and a few months later you say, well, you know what, I'm now going to go to somebody else.
And you can lock it in. And the tax and the interest payments are tax deductible.
Absolutely. So it's an unusual thing. And the GDP was not affected for 7 years from construction. And that was Bernanke went, we've got to get that going. And he did. He got that moving, and so history will offer that it seems pretty obvious, picks up the mortgage market, fixes up the property market, gets people working. That worked, but he then lost control around having that conversation. He spoke to a Fed at a Fed meeting, and he was asked, "What would you do about taper? When are you thinking?" And he said, "The US
sometime later this year, looking to do that."
Looking into September, and then they wanted to. Everyone went berserk. They wanted to re-clarify, and so he thought he'd be quite smart. And he said, "Well, this is what we're considering." And then the market just sold off, and that was where you would have had all these conversations about bonds.
That's when we did have clients coming in saying, "What's all this about?" That tends to be what mum and dad say. What's all this about?
Because they see all the noise.
Yeah.
Okay, so we'll talk a little bit more about that after the next break, and I think we now have to go to another break. So we'll have a very short break. We'll be straight back. Please feel free to give us a call, 1300 30 34 35. Email yourmoney@skynews.com.au. We'll be right back.
Thank you. That'll be $10, please. Okay, here's all of my card details. $250, please. Okay, here's all of my card details.
That'll be $150, please.
Okay, here's all of my card details. Oh no! Stop giving out your card numbers all over the net. No one sees your financial details when you check out with PayPal.
I'm looking for a provider who gives me everything I need to trade Forex in one place.
I want customizable charts developed for Forex traders, transparent prices and a stable platform.
I want a provider that presents me with Forex trading opportunities 24 hours a day.
That's why I trade Forex with IG, Australia's #1 Forex provider.
Whatever their personality, every dog deserves leading nutrition. For healthy digestion, a shiny coat, immune support, and healthy teeth, choose Pedigree.
Don't miss your one-off opportunity. Take advantage of exceptional BMW value during a BMW One program. Like 1% finance on the ultimate driving machine, the 3 Series sedan. The one-off opportunities are strictly limited, so act now.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi.
Ben?
Yeah.
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
Welcome back to the Bonds and Equities edition of Your Money, Your Call. Feel free to give us a call on 1300 30 34 35. The email is yourmoney@skynews.com.au if you have any questions on bonds or equities. We have our first email for tonight. It's an email from Sebastian, and he writes, Hi, if you hold a bond investment for a year, what are the advantages and disadvantages of buying bonds either via a broker or on the ASX? And also, what are the advantages and disadvantages of buying bonds either via a broker or on the ASX? If a client comes in and asks you, what's the answer to that?
Yeah, so I guess what we would say to Sebastian is we wouldn't like to advise a client to hold a bond for a year because of the volatility. So we would struggle with that because we'd be saying, well, you know, you should be holding bonds for a minimum of a 3-year time frame to ease out the volatility. So I'd have to look at why it's only going to be held for 12 months, probably in that example. That's probably where we'd sit on that.
I mean, I think the other thing is if you want to hold something for a year, just buy a 1-year bond. Term deposit, 1-year bond or whatever else, so that will mature. Or if you've got a view that you buy something that's really liquid, you can always sell it like
and you can, like a hybrid, you can sell, but that price drops during the 12
Yeah, that's right. But if the focus is on the fees, that's sort of a little bit putting the cart before the horse. You've got to look at the underlying credit and work out what you like. And that makes more sense. So I would look at the underlying credit, I'd look at the goals. If you can only invest short term, you have to bear the consequence of cash rates will be what in the next year, 2.5? Yeah. So you're not going to get 8% returns, are you? You're not going to get, you're going to be getting
unlikely to.
And if you buy some of the majors, you know yourself, you can buy the banks buy all that paper anyway. So it's hard to get really good returns in that part of the curve. Which leads me to the question about SMSFs. That's your area of expertise. It's the fastest growing sector. I spoke about it last week. 500 billion, 670 every month. You know, what worries you about that? What worries you about that level of money?
Yeah, I mean, and it is huge. I mean, I think it's 5 times the size as it was 10 years ago. Which, you know, I know 14 years ago when I started getting involved with our practice, I knew it'd be big, but I never thought it'd be this big. A couple of things. I'm not too worried about it. The auditors of self-managed funds are doing a really good job, and the quality of audits has increased dramatically. And what I mean by that is clients now are saying, my goodness, Craig, why are we getting all these queries on our fund? And that's because auditors are really stepping up in making sure that these funds are compliant.
So the auditor, just so for the folks at home, I'm running my own self-managed super fund. You take it, you're my planner, you take it to an independent auditor.
Exactly right. So at NavWealth would do the planning, we do the tax return, and then we have an external auditor who looks at that fund. And basically they'll look at that fund and say, oh, we're concerned about this or we're concerned about that. And then we go back to our client, the trustee, and say, gee, we need to get back to the auditor with this. What have you done here? What have you done there? And that's really improved. You know, 10 years ago, you'd get 2 or 3 audit questions. Now you'll get 20 audit questions.
Can the client answer them?
Sometimes they need a bit of a hand with us. If it's a complex fund, like it might be a super fund that has property and trusts hanging off the super fund and property inside the trust, I mean, they can get quite complicated. And that's where the auditors then are starting to ask lots and lots of questions.
I wouldn't have thought that would be cheap to have the auditor do that. Is that an expensive exercise?
It starts at about $500 and it can go up to thousands depending upon how complicated the individual fund is.
So what if I'm opening my own self-managed super fund, what sort of money should I have?
Yeah, and this is a question that's commonly asked, as you know, and I come back to how are you going to manage it? So if we get a client come into, I'll start this way. We think there's 3 types of trustees. There's the absolute do-it-yourself self-managed fund trustee who really wants to wake up in the morning, get onto their computer, look at stocks and look at bonds and do the whole thing themselves. So they're going to be managing that quite cheaply because they won't be using many advisors. The second type of advisor, which we have a few of, wants to do some of it themselves and then outsource other parts of it. And the third type doesn't want to really do anything except have control. So they want a lot of help. So that third type, you know, if you're under $500,000 in your fund, it'll be more expensive than probably a retail super fund. So the size for us really starts at $500,000 in our practice. But our average fund's over $2 million. So like we've got, you know, quite large funds.
And yours is quite a big business, or?
Oh no, not huge. But I guess because we're in Sydney on the north, which is near Mossman there. So I guess because of our location, we tend to have, you know, fairly affluent clients.
Does Nomura target that sort of sector? I mean, 500 billion. You know, how does that from a business strategy for Nomura? You know, tell me a bit about that.
No, we don't. It's a wholesale counterpart.
You don't have that licence.
We don't have the licence in Australia for that. It's probably something we do have in Japan, which we have more of a retail base, but not SMSFs as such. But in Australia we don't look at that
because it's very tricky, isn't it? Trying to be the type of organisation that can service that. I mean, you look at Nomura and they be going, what's the return? I suppose if it continues to grow, they might.
There's a lot of licensing around that, and it's also staffing and compliance.
I mean, it's a heavily regulated type of industry, you know, and the government's always trying to protect them from themselves, and we see so many headlines, you lose money in storm, and therefore it's, you know, we just assume that you don't know what you're doing, so we'll regulate to that end. What's the sort of client base for Nomura? Who would that be?
So the institutions, commercial banks, fund managers, hedge funds, central banks, the larger...
Tell me about the central banks. I mean, what's the... How does that work? You know, 1-800 Yellow Pages. I'm going to, you know, how does?
Well, every country's got one.
Yep, that's a good start. So there's a few countries around.
They're a conservative beast. They manage their country's assets.
Yep.
They typically, historically, have had big US dollar portfolios, so they own fixed income assets. A few of them will own equities, but very, very few. Mostly it is called reserve management. So they hold fixed income, which is readily able to be sold in the wholesale market, and they were able to get cash. And they use that cash from time to time to intervene in the foreign exchange markets to stabilise their currencies. That's the base of what they do.
We'll talk more about that in a second, but we have to go to a very short break. If you feel free to give us a call, 1300 30 34 for any investing questions or talking about Reserve Banks. The email yourmoney@skynews.com.au. We'll be right back.
The Volvo company car and demonstrator sale is now. Save over $7,000 on a wide range of selected models. It's for this month only, so hurry to your nearest Volvo dealer today.
It's really nice.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi!
Ben?
Yeah.
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
Life is a journey in which we're all travelers. Looking to make that great trip with someone. Journeys are made by the people you travel with.
Stonefield have shown us what they can do with $1. Now it's your turn. Go to $1daday.org to find out how.
This week on Australian Agenda, new Treasurer Joe Hockey is in Washington learning a thing or two about economics. That's no bad thing if he's going to continue his backflip on paying back the debt anytime soon. Live from Washington, we speak about the US debt crisis, the ongoing global financial concerns, and domestically, how will he pay back Labor's debt? Speaking of Labor, their drawn-out leadership contest comes to a head on Sunday. Who will lead Labor to defeat at the next election? We speak to Federal Labor's President, Jenny McCallum. That's this week on Australian Agenda.
Welcome back to the show. If you have any questions on the bond or equity market, feel free to pick up the phone. Call us 1300 30 34 35. The email is yourmoney@skynews.com.au. So we're talking about the various central banks. The IMF have come out and they've said the world economies are slowing and everything's a little bit ugly, and Australia's linked to China, and China's going to go 7.75 to 7.5, whatever it was. What's your thoughts on that in terms of the IMF, and without wanting to, can you say what you think of the IMF?
Yeah, absolutely. I think they're a credible institution. It's the third time this year that they've downgraded global growth. So they've got some form in doing it this year. They sit above politics, and so they're not subject to, say, the political problems that you get from Australian Treasury in the political situation recently, or the Congressional Budget Office in the US. They are concerned with global growth. They're certainly very concerned with the political situation in the US at the moment, and to the point where we will see a very sharp contraction in Q4 growth in the US, which could unsettle global growth. It could really see government shutdown. There's no activity. We mentioned earlier, and I think it's particularly pertinent for a lot of your clients, the lack of confidence that we've seen in Australia, which has picked up since the election. You get a lack of confidence in the US, people don't spend, people don't buy houses. The consumer, while we don't deal with the consumer as Nomura, the consumer matters very much in terms of our view of what activity will be like, and certainly for central banks and the IMF.
Big problem, hasn't it?
Yeah, it has been the consumer. They're dead. Retail sales are low. Credit growth is still at 35-year lows, and most of the credit growth we see is actually refinancing.
Yep.
Savings rates are still very high in the Anglo countries, 10% in Australia, and that money's not being spent. And you don't spend money, you don't go and buy a new house or build a new house, which is the biggest asset for most people in their life, unless you're confident the job's going to be safe. Now, if you're a US government worker, you're not getting paid.
It's hard to believe. It's these furloughs. It is just
800,000 people so far.
Yeah.
Now they'll get paid.
800,000 people who've been furloughed, which means you don't get paid for the furlough.
You don't get paid while you're on furlough. You get paid afterwards, and you get paid back. But I think given you'll have a slowdown in the economy anyway, I mean, it's just inevitable and it's happened, you won't be spending. You won't be spending at Halloween at the sales. You won't be buying that new car or the new snowshoes for the upcoming winter in the US.
My brother-in-law lives in the States and he was supposed to fly over for his father's 87th, I hope I got that right, Warwick, his 87th birthday, and couldn't get on a plane.
Really?
Didn't happen. He just could not get the time because of all the problems with the air traffic controllers, all the different nightmares, and because of the way he had to fly, he just could not get on the plane and went, it just isn't going to happen. It's going to take me forever to get over there. And I think that has an effect. America's such a big internal travellers. It'd be people saying, I don't have any money, I'm not going to do it. It will have a slowdown. It'll be interesting how America continues to reinvent itself to compensate for the slowdown.
Thanksgiving Day is traditionally the biggest holiday in America. It's coming up. Everyone travels home for Thanksgiving Day.
Yeah.
If you don't have the money to pay for that ticket, because unemployment's still high and your wages have been low for the last few years, you're going to travel at Thanksgiving? No. You're going to spend money? No.
It is a massive holiday. I mean, it's the #1 holiday.
Yeah.
And if they don't do that, you're right, it would be very bad. So what's the equity story? Why is it the equities are going to be, moving? I don't really understand why we're going to receive that. It's just because cash is cheap.
In terms of going up, or
in terms of going up, in terms of the idea that you've got to get in, move on, see it.
Well, that goes to the forward guidance. If they know that interest rates are going to be low for a period of time, then your input cost in terms of your financing is going to be low. It is positive for equities. In the short term, though, the confidence loss, the activity loss, the consumption loss from the government shutdown is going to have effect, and as we've seen equity markets fall around the world in the last few days.
How do you see the Australian economy at the moment?
Again, it's patchy. If I look at our self-employed clients, so our mums and dad businesses, which range from really small to quite medium-sized businesses, what we're noticing in those businesses is their issues profit. They're struggling with profit, so they're all turning over lots of product or whatever they're doing, but their margins are hugely squeezed, and that's nearly every tax return we do for a business. So that's the challenge we're seeing in small business, is the margin issue.
Can I, buddy, do you have, in that question, are there certain businesses that you have more expertise in, or are you talking about, when you say all my businesses, you could be doing all news agencies, do you know what I mean?
No, it's quite broad. We've got importing businesses, they're doing okay, but anything to do with service, where it's down to big hourly employment costs, they're the ones that are struggling, because it's just so expensive. Wages are so expensive.
Is that something that you think with the new government coming on, and they're not saying they're going to change the industrial relations laws dramatically, but there's certainly a sense, I think, in the confidence and business confidence in that there'll be a movement around some of the award wages or some of the loading that you've got. Is that what your clients are thinking as well?
Yeah, I think we've got to do some things. I mean, a lot of the cafes that we have as clients, the few we have, I mean, when they start employing kids, really, on Sundays and periods of time, what they're getting paid hourly rates is crazy. And they're kids, it's their part-time job.
What are they getting paid?
Like $25, $30, $35 an hour.
Yeah, right.
And
that's a lot of coffee.
That's a lot of coffee. So our clients are going, why would I bother? Why would I bother opening? And that's so we've got to try and find that happy medium, I think.
When just before we came back on, we were talking about trends in customers. What are the trends that you're seeing in your customers?
So one of my sort of things I love watching actually is how different generations spend their money. So if I look at, say, clients that are 70 and above, they're very cautious spenders. They grew up in tough times as a child, and I think that's still with them today. So those clients, we have some clients that are retired and they could travel the world 3 times every year, and they'll say, oh gee Craig, we better watch our spending. If I then come down to their children, who are sort of, or maybe not quite their children, but people in their 50s, they're spending big time. The kids left home, hopefully the mortgage is gone, mum and dad are now working, so they've got more cash flow than ever before, and they're the big spenders. When they move into retirement, that'll change as well, because they won't have probably the assets behind them to continue that spending. And then when you go to the next ones below that, say the people in their 30s, they just spend everything. So what's going to be interesting is the people in their 30s, what are they going to do when they're in their 60s? Now, inheritance is going to help.
Work harder.
And inheritance, I mean, we see inheritances save the day for a huge proportion of the population.
Really?
Huge proportion that we see.
What trends are you seeing in your clients?
Well, institutions, obviously, as I said at the beginning, were quite concerned with what's going on in the US. So in terms of making new investments, people are what we call de-risking. They're taking less risk on. Getting into the end of the year anyway, so for balance sheets and for funds who report at the end of the year, they don't want to take new risk on. The markets are very uncertain. They see the economy as patchy, so they're not quite sure, and they're not quite sure of the path of interest rates, particularly in somewhere like Australia, where we seem to be at the bottom, and probably are at the bottom of the interest rate cycle. But when are they going to hike?
Yeah.
The interest rate curve suggests that by mid-next year, October next year, you've got 11 basis points of hike. So that's not a full hike, it's just under 50% of a hike. We don't think that's realistic, but I guess a lot of the investors feel the same way. They're not quite sure.
How do they de-risk for the viewers at home? What do you mean by that?
Well, if you have a trade-on that has some leverage in it in swaps, or you have taken an oversized position relative to a benchmark, you sell that down.
So a benchmark might be BBSW, or a benchmark might be the UBS
bond index, or the credit, or you have more credit in your portfolio than what the benchmark suggests, say a 60% weighting to credit rather than a 40. Yeah.
Okay. We will leave it there. We'll have another very quick break. We'll be right back in a moment. Stay tuned. Oh.
Engineered to endure with a lifetime guarantee. Taubman's Endure.
Hey kids, look at this. It's called forward collision mitigation. It's like the car has its own eyes. And then there's adaptive cruise control. Do you hear that, Jane? Adaptive. And don't get me started on MMCS. It's amazing.
Mission control to Orbiter 1. Do you copy? Mission control to Orbiter 1. Tom? Tom, do you copy?
The new 2014 Outlander. With so much technology, it's out of this world.
Our bones need vitamin D, but 1 in 3 Australian adults aren't getting enough. Strong women need strong bones. So if you think you're at risk, ask your GP about Ostalin or visit us online.
Start up like this, or like this, and hit the start button to flip back and forth. You can make the important things big, keep the small stuff small, and arrange it all around you. You can be all work, all play, or even both at the same time. You can do it all, simpler and easier, on your Windows tablet, PC or Surface. That's the new Windows. One experience for everything in your life.
Mont Blanc Legend. The fragrance.
Where's my store?
Welcome back to the Bonds and Equities editions of Your Money, Your Call. And joining me on the panel tonight is Martin Wetton. He is an interest rate strategist at Nomura, and Craig Banning, who is a director at NAB Wealth. They're here to take any of your phone calls, so feel free to call 1300 435. You email yourmoney@skynews.com.au. We have an email from Anne, and Anne writes, "Hi, my stockbroker told me that the equity market could rally 20% next year. Then why should I buy bonds? I love the show, but I haven't bought bonds yet." Well, we live in hope. Great question. I'd be surprised he said it was only 20%. He could have said 40%. The
Bit of a smudge on the crystal ball.
That's right. You know, what do you say to Anne when a customer comes in and says, "Look, the stockbroker's saying this"?
Yeah. So I guess to start with, crystal balls always worry me because I've never got the crystal ball quite right.
Yeah.
But we always start with, and we don't know in this case with Anne, is what is Anne's current asset allocation?
Yeah.
We don't know
Clearly,
that.
no bonds.
So she's got no bonds, we know that. So
I can help her there. We've got to buy some bonds.
So in Anne's case, you know, we feel we've got to diversify clients' portfolios across asset classes, mainly because trying to predict which asset class is going to fire on ahead of another.
Yeah.
Boy, it's difficult. I mean, 23 years I've been in this job, and it's impossible to get it right because there's too many variables around the world that are constantly changing the game plan.
I call it the Rumsfeld portfolio. The portfolio you have when you don't know what's going to happen. I mean, you don't know what you don't know, so you've got to prepare for that. So buy something that gives you a little bit of the sleep pattern that's consistent, and then the volatility that comes out. But that leads me to the latest theme is around this black swan stuff. And for the viewers at home, a black swan. When I asked the gentleman this question, it doesn't make any sense because a black swan's supposed to be an event that happens that you had no foresight of it happening, so that becomes the black swan. So when I ask them what their black swan is, they shouldn't be able to answer it, but I will. For you guys, what's a black swan moment for you? What are you looking at and saying, hang on, that's...
Well, the thing we most fear, and we attach a very low probability to it, therefore a black swan, would be a default by the US on its government debt.
Yep.
We don't think it'll happen. It seems very unlikely.
Do you think... Sure. Do you think the Tea Party guys would like to see it, Cruz, Rubio, just to see what happens?
If they don't want a future in politics, yeah, I'm sure they're happy to see that. If they will be blamed.
And now remember, they are Tea Party guys who said that they'll never vote for a raising of that ceiling.
Yeah, and some of them, the more moderates, Boehner, the House Speaker.
It's a funny name.
It is Boehner. He is someone who has also said, and I'm not here to see a default either. Now, they have to be very careful around it. October 17th, it's 1 week away.
Yeah.
After that, the Treasury loses sight of its payments. It's got 27 different payment systems. It can't prioritise, even though it says it wants to prioritise debt over paying a defence contractor. It can't do that.
Yeah.
So... unless they get something done in the next week, you've got...
And how hard is it to get it done? It takes some time to write that legislation to do it?
Well, earlier this morning, Obama, the Republicans actually caved in a little bit, and early this morning Asian time, and the Republicans said, look, we're prepared to compromise and lift the debt ceiling on a 6-week kick the can down the road situation. Obama fired back and said, no, not unless you open the government. Now, he's playing hardball with them, because this is about the third time he's had to deal with this. It is not that difficult to get it done, but it really is about the process of the US government and Congress and the House, Congress and Senate actually agreeing that these are incredibly important things, and to let it go is a very irresponsible way to run policy in the country.
But Craig, doesn't it look to you that it's already irresponsible? So why would that's really irresponsible behaviour, as was what you did before. So why wouldn't you see? I mean, for me, it's more around fundamentalism. It's around dogma, and it's about the Tea Party saying this is what I'm believing in. And so then, when we say, but that's illogical, well, okay, it doesn't matter. I believe in it. So doesn't that look at to outside eyes like yourself when you say, well, I could see it happening?
Yeah, I mean, the whole thing's strange to me. Like, everything just seems to happen at the last minute. So I think they'll get it over the line.
As do we.
Yeah,
everyone thinks we'll get over the line.
We'll get over the line. It just ends up a bit of...
So, in your business, mate, what's the black swan for you? What are you concerned about?
So we talk to clients about there are things you can't control and there are things you can control.
Yep.
So trying to, as I mentioned a minute ago, trying to move assets around and predict asset allocations and control the world just is impossible. It's out of your control. So my concern is when clients do try and move their portfolios around asset allocations aggressively, that they're just out of the market. And there's been so many studies over the years that's shown if you stay into an asset class over the long term, you'll win, versus coming in and out of that asset class in dramatic moves. We're not talking 3% moves, I'm talking in and out at 50% swings, which some mum and dads try to do. And it generally ends up in tears, because we find clients are much happy to make money, but they're very, very unhappy to lose money.
Yeah, please don't be that sort of investor clients. But I mean, don't try and pick markets. It's too hard. There's only one Buffett for a reason.
Yeah.
Consumer sentiment is on the up.
Yeah.
But they're not going to spend money. Or I don't know that they're going to spend money. What's your thoughts with consumers?
I think certain generation bands will spend money. The question is, I guess, the ones with the money, are they going to spend it?
Yeah. I suppose, in my mind, that's the greatest quandary for the RBA. You know, so for the RBA, they've got to get the consumer to act. They've moved rates down, and now we're seeing the property market move. But the question is, at this point in time, the property market's moving. We're not quite sure who's buying. Is it investors or is it people?
We're seeing on the property front investors. So we've had more clients come in and talk to us about property in the last 6 months than in the last 5 years. It's just taken off again, all these queries. But what's interesting on spending on retail, which is why I think they need to work on their business a bit. I got some gift vouchers to a certain store for my birthday recently. So I go down to the store and I've got 5 gift vouchers for $350. And the guy in the store says, Craig, I'll give you 35% off straight away. And I sort of stood there and thought, why would you give me 35% off? I've got these gift vouchers.
Can't go anywhere else.
I can't go anywhere else. Give me a free belt or something. You know, so I think sometimes we need to work on that.
We'll have to talk a bit more about the spending, but it's time for a very short break. Jade has just told me we have to go, so we'll be back in just a moment.
Roger, bath time. Look what I've got for you. Schmackos. Roger? Rog.
That's so wacko for schmackos.
Copy that.
I don't care. I love it. I don't care. I love it. I love it. I don't care.
From 24,990 drive away, the new 2014 ASX is the street smart SUV.
G'day, mate. You just bought me. Great. See you next week.
Gracias, Senor Cad. I am all yours.
Cheerio. See you in Australia. Merci, Monsieur Cardi. I am on my way. Au revoir. Enjoy the flight.
Stop putting yourself at risk over and over again.
What?
Get up to $20,000 worth of buyer protection when you check out with PayPal.
What are those?
Odds? Try.
No. I don't like trying new things, no.
You like these?
Pods. Embrace the chew. Befriend the crunch.
They're quite good.
This week on Australian Agenda, new Treasurer Joe Hockey is in Washington learning a thing or two about economics. That's no bad thing if he's going to continue his backflip on paying back the debt anytime soon. Live from Washington, we speak about the US debt crisis, the ongoing global financial concerns, and domestically, how will he pay back Labor's debt? Speaking of Labor, their drawn-out leadership contest comes to a head on Sunday. Who will lead Labor to defeat at the next election? We speak to Federal Labor's President, Jenny McCallum. That's this week on Australian Agenda.
Welcome back to the program. It's the last segment of the show, so let's get right back into it before we were interrupted by Jade and the desire for ads. What happened? The guy says give you a discount. What did you tell him?
Yeah, so what I did is I finished my order, which was about $400 odd, and finished the order. And then I said to him, mate, are you the manager of the store? He says, yeah, I am actually. I said, look, can I have a little talk to you about why did you give me a 35% discount when I had a gift card?
Couldn't go anywhere else.
Why did you do that? And he goes, oh, well, you know, we like to look after our clients. And I said, well, but you've got to make money too, or you won't be here next year. So why couldn't you have given me, say, a free belt, which costs you $10, that retails for $25, then you would have only lost $10 instead of losing 30% of nearly $400.
So the retailers are, at the moment, obsessed with the discounting because they feel that's what they've got to get the client
I
into.
wonder, is that the culture we've got now?
And is that leading to what we're talking about before, where the RBA is saying, I've got to drive interest rates lower to get the consumer to behave. The retailer's saying, oh my God, you know, it's a disaster. So they're cutting rates. We see property booming because of investor, you know, speculation. But at the same time, we expect unemployment to go up.
Yep.
What's the RBA going to do?
Well, they've got a fine line to tread. They are seeing housing going up, you know, those sorts of inquiries you talked about. They're not seeing it in the construction, which is where they did want to see it. They wanted to see that rotation out of mining into the construction sector. They're seeing existing houses go up. Great if you own them. Good for wealth effect, but not actually GDP creating. they don't want to put rates up because, well, they don't want to put them down much more, if at all, because they fuel that housing bubble that people want to talk about. They don't want to put them up because they attract capital, pushes the Australian dollar up, and it hurts some of the export sides of the economy.
You were telling me before the last cut, how much has the Aussie appreciated? How much has it gone
That's
up
6%, so it was around 90 cents or a little under 90 cents at the August meeting. I think we're at 94.80 today.
Something like that,
Yeah.
It must be really frustrating for them, you know, lowering rates to 100-year lows or whatever, forever year lows. And yet they can't get that currency to move down.
They can't, and one of the perverse things is that you've actually got some investor bases on the institutional side who would look to buy into Australian dollars or Australian fixed income markets because the RBA has stopped cutting rates, simply because the currency appreciation that they'll likely get is going to lift their capital gain as an investment.
Because they buy Aussie at 4%, Aussie bonds at 4% for a bit, and then they do the conversion in the capital. And it seems, you know, what were you telling me about in terms of the IMF now reporting in Aussie? How much is of the sovereign wealth fund?
So a couple of years ago, the IMF decided it would split out its portfolio of sort of what is the best investment portfolio, and they put Australian and Canadian dollars in there as reserve currency. So it gave them its official status, about 1.7%. 1.7% of several, about $10 trillion, fair amount.
And they didn't put the Kiwi in there, did they?
They didn't put Kiwi in there, no. They kept them out.
Check when I keep the Kiwis out of something. I mean, my gosh, the football's killing us. Look, that's all we have time for today, so thank you so much to my guests, Martin Wetton, interest rate strategist at Nomura, and Craig Banning, a director at NAB Wealth, and to you, the viewers, for the emails. Until next time, I'm Mark Todd from FIIG Securities. Have a great Friday night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
If you're thinking you've found the one, chances are someone else is thinking the same thing.
Oi.
Ben?
Yeah.
That Ben.
With ANZ Buy Ready, you'll be ready to make your move.
We'd like to make an offer.
Great. We'll step through this way.
Talk to Australia's most awarded home lender, ANZ.
We make selling a car easy. List it in a snap. Compare similar cars to yours to set a good price. And with Privacy Protect, it's even safer. Car sales. Easy.
In 2014, the world's greatest heroes will join forces for the biggest movie ever assembled. And your child could be among them. We're looking for Australia's #1 fan of the Lego Movie to win a chance to voice a character in the upcoming animated adventure. If you're a Telstra customer and your child is between 5 and 12, just head to facebook.com/Telstra to enter today. Telstra takes you there just to say thanks. The Lego Movie, assembling in cinemas 2014.
Life is a journey in which we're all looking to make that great trip with someone. Journeys are made by the people you travel with.